Hi, I keep getting the following question. Since sleuthing is so time intensive, how do I know a stock is worth all my work? Well, let me quote Enrico Fermi, one of the giants of quantum physics. He said, in essence, it's better to be approximately right than precisely wrong. In other words, first estimate the answer roughly before you waste your time on questions that don't matter much. In fact, many companies use this method in interviews to see how candidates think before going with them any deeper. A simple question would be, how many golf balls can fill up a school bus? You have 4 choices for answers. How to choose? First, do it approximately. Estimate the size of both bus and ball in the same units. Estimate the volume of each. Finally, divide one by the other. Even an approximation would show you which answer is closest, at least by the order of magnitude. See? Well, let's see now if we can use Fermi's approximation method to check if a certain stock is worth sleuthing. How? By estimating how high it would go if, as a first cut, its value ratios would be similar in the future as in the past. What are value ratios? These are the multiples you pay for values in the company. That is, the stock price divided by value inputs, such as book value or revenues, or value outputs, such as gross profits, net profits, or cash flow. But since the market price fluctuates, so do the price to book and the price to revenue. It'll be the same with price to profit, also called the PE ratio, or price to earnings ratio. The problem with PE, though, is that when the company's stock is cheap, profit, the E, the earnings, is probably low too, or even a loss. But revenues, hopefully, is still there. So if you get the revenues cheap, and if one day it again produces profit, yes, if. But that's what sleuthing is for. First, though, you want to make sure you can buy the revenues cheaply before you start your sleuthing on the company. For this, you want to see the historical record of price to revenues and where it is now. Well, I hear you grumble, to compute all these numbers is a lot of work. It would take me ages. No, it wouldn't. You can get all these numbers for any stock, public stock that is, from one page of ValueLine, perhaps the best financial data service. But you may ask, won't it cost me a fortune to subscribe to it? No, it used to. Today it's free. ValueLine, which by the way is also Warren Buffett's favorite financial summary, is now available online from most public libraries. I use it almost daily for free. Let's take one stock as an example. Look it up on ValueLine and see how we can estimate whether it is worth sleuthing at all. The stock is ADS, Alliance Data Systems. It's a big company with more than $7 billion in revenues last year, providing database loyalty programs like air miles. It has 8,500 employees, went public in 2001, and then soared from 12 to 300 or 25 times. Unfortunately, or maybe fortunately, due to COVID, the stock plunged to 20 in March this year when it lost almost half the revenues. It's about $45 today. Now, why did I choose it? 3 reasons. No, 4. First reason, ADS has the rarity of having all top governance grades of 1 out of 1 to 10 in all 5 categories. I'll tell you more about these categories in the future, but let me just say here that it shows management is unlikely to cheat you, unlikely to cook the books, and unlikely to overpay themselves. These grades, by the way, are available in Yahoo Finance under a company's corporate profile. Now, was this the only reason? No. As I said, there were 4 reasons. Governance is 1. The second was insiders buying. When ADS fell to 20, down 93% from the peak, there began a wave of insider buying, with some still buying at 50. Today it's 45. So that's it? Good governance and insiders buying? These are my reasons? Nope. The third reason, the buyers who bought are savvy. How do I know? Well, there are also those who sold at 280 and 300 before the deep fall. Super savvy, I would say. And as I said, there was also a 4th reason. The company has a very high return on equity of more than 50%. That is, the business is high quality with fat margins, which indicates a unique business advantage. So, summing up, high quality business, high quality management, savvy insiders buying, and revenue fall due to a factor not of the company's fault. The stock is now 85% down from the peak, still below the last insider purchase at 50. The Fermi question would be, if ADS goes back to normal, how high can its stock go on the same past value ratios? We don't need precision here. Approximately will do. Why? Because if the stock can only go moderately higher, say to 60 or 70, then there are other stocks to sleuth. But if the stock can get anywhere near the former peak, it will be a 10 bagger for the first insider buyer and still 5 or 6 bagger for those buying now. If the stock can get up there again. If. Can it? Let's go to ValueLine. If you look at ValueLine's ADS page, you can see a table of important financial ratios for the last 15 years. And you'll also see an estimate of what these will be in 5 years, in ValueLine's opinion. Please note, I'm not talking short-term earnings estimate. Those by ValueLine or anyone else are usually worthless. But I'm talking 5 years in the future, because if the company is good, as ADS appears to be, ValueLine's long-term estimate is usually a good starting point, so long as you reinforce it with sleuthing later. Your sleuthing. Remember, sleuthing is essential. Your work. This early part is only targeting your work. So here goes. In ADS case, we see the 15-year price to revenue range was about 1.5 times to 2.5 times. Just take the stock price from the chart on the ValueLine page and divide by the revenue per share right below it. So if we estimate what revenue will likely be 5 years from now, we can have a rough estimate of the stock price range, assuming the business hasn't gone bad, which you'll only find by sleuthing it later. So what would ADS revenue per share be in 5 years? ValueLine estimated at $140 per share, almost as high as the peak, almost, but not quite. In other words, it's not too aggressive. ValueLine doesn't call for heroic growth, just getting almost back to previous high in 5 years, not 1 or 2, not even 3. Is it reasonable? Yes, maybe, because the revenue decline was not the company's fault and its business is already recovering. The company already is signing up new customers, which of course we'll have to verify and confirm by sleuthing. Therefore, if ADS stock will again trade at past multiples of revenue per share of 1.5 to 2.5 times, and revenue per share will be 140, a peak price of 210 to 350 is probable. Remember, previous peak was 300 and it's now 45. But will it get back to 300? That is, will higher revenues produce the same sort of profit? It's a good question. For this, we have to estimate the profit per share that this revenue per share will produce. The ratio of profit to revenues is called net margins. From ValueLine, peak margins in the past was 16.1%, which, by the way, is very high because of the high business quality. ValueLine estimated that in 5 years, ADS will get back to a margin a little bit below the peak. It's good enough. However, in my humble opinion, ValueLine is maybe too low here because, like most companies after COVID, ADS is now cutting costs to the bone. So it's likely future costs will be lower than the past. They already are. And so net margins will likely be at least the same as the past, maybe even higher. Besides, for some reason, ValueLine sees revenues 5 years ahead only at $6.6 billion, below the peak of $7.8 billion 2 years ago. Still conservative, in my humble opinion. In sum, I think both ValueLine revenue and margin assumptions are likely somewhat low. So if both reach previous levels, EPS can be higher too. And if both revenues and margins surpass the past, even by a little, then we can see the stock price rising above the previous peak of 300. But even a shade below 300 will be okay for me, no? Multi-bagger, here we go. Or do we? Of course, it can also not get there and lower. But to know which is the case, you'll have to sleuth the company's business in details, its people and products, competition and clients. See my book, The Sleuth Investor, for the method. But at first blush, as per Fermi's method and ValueLine, ADS does look like a promising candidate for your physical sleuthing. Remember though, the above is not a recommendation or a tip, just an example. Rather, see it as a template for an initial estimate of any other stock you may be considering to see if it's worth your spending time on. Finally, as homework for estimation of a stock's target, here are 3 more stocks for you to practice on. Meredith Publishing, symbol MDP, Park Hotels, symbol PK, and Galaxy Games, symbol GLXZ. A warning though, only one of these three, or at most two, maybe worth your sleuthing time. It's for you to find out which. That's all for you today. Let me know in the comment below what you think of the above. Subscribe to the channel. Tell all your friends about it so they subscribe too. I'll see you next time. And meantime, thank you very much for watching.